In the 31 years since their debut in the US, exchange-traded funds, ETFs, have greatly expanded to now manage more than $9 trillion, spread across more than 3,000 distinct funds. And of course, like mutual funds, ETFs provide an opportunity to diversify your portfolios. And as many of my viewers will know, in addition, ETFs provide a couple of key advantages. They provide low fees, they are tax efficient, they offer trading flexibility, and they also offer transparency with regard to the underlying holdings pretty much at any point in time. And as a result, it should come as no surprise that over the years, ETFs have become more and more popular. We have seen significant inflows and increasing inflows pretty much every single year into ETFs. While on the other hand, we saw outflows from actively managed mutual funds. In 2023 alone, investors piled around $600 billion into US ETFs, showing once again that investors overall tend to favor ETFs over mutual funds. However, and that's the point of this video, overall the structure of the ETF market and the types of ETFs offered within the ETF umbrella have changed and now include purely passive ETFs, which most of you will be familiar with, thematic ETFs, and purely actively managed ETFs. And that's the type of ETF I want to talk about in this video, so-called quote-unquote active ETFs. And this evolution of the structure of ETF products means that the term ETF can no longer be used as a synonym for passive investing. And again, just to provide some context and some numbers here, overall active ETFs have grown from around $112 billion in 2019, almost $700 billion by the end of May 2024 in assets under management, a compounded annual growth rate of 40% according to BlackRock data. This also means that the growth of this type of ETF is significantly higher than the growth of your typical ETF. And just to wrap up this numbers part, BlackRock also expects the total assets under management under active ETFs to grow to $4 trillion by 2030. So what I want to talk about in this video is whether these so-called active ETFs should be considered a blessing or curse. And so without further ado, let's get started. All right, so I think you can easily make the case for active ETFs being a blessing. You could argue that they are once again helping democratizing the world of investing. They make investing products more accessible, they make them cheaper, maybe also more transparent. But on the other hand, I think you could also argue why active ETFs could be considered a curse. You might argue that these are just a new instrument that is first and foremost helping someone else to become wealthy, and they are not necessarily primarily being focused on making you as the investor in this product rich and wealthy. So we'll get to this discussion a little later. Let's maybe start by briefly explaining what an active ETF actually is. I think many of you might have not heard of this term before. So let me just highlight a couple of key features of an active ETF as opposed to a passive ETF. So I have highlighted a couple of features, as I just said. One would be that, of course, active ETFs are actively managed. There's an actual portfolio manager that is determining when to add new positions to that ETF portfolio, when to trim positions, when to sell positions, and so on and so forth. The weighting of the positions within the portfolio, basically what an active fund manager in a typical actively managed mutual fund would do as well. And now, of course, the providers of the active ETFs, well, they would obviously highlight that the research done by these active managers, well, this is going to create value to the clients. It may help to mitigate risk. It may help to diversify across a wide range of industries. It may help to get exposure to high quality companies and so on and so forth. Now, another feature, and that's something that active and passive ETFs have in common, is the transparency. Basically, you can check what you actually own under the ETF umbrella at the end of every trading day. You can, for example, go to the Ark Fund's website. So you might associate that fund with Cathie Wood. I think she's pretty much the face of this investment company. And I think you can check daily what the underlying holdings within each of her products actually are. And while this is not necessarily a difference between the active ETFs and the passive ETFs, it clearly is a difference between active ETFs and an actively managed fund, or maybe a hedge fund even, that may only disclose the holdings on a quarterly or maybe only biannual basis. Then another key benefit that is worth highlighting, and that I believe in too, would be the factor or the feature of the underlying or associated costs of the product. Clearly, and we'll take a look at a couple of examples in a second, active ETFs are on average cheaper than actively managed mutual funds. And then finally, just to wrap it up here, one might argue that an ETF maybe also be a little more liquid and, depending on your circumstances and your jurisdiction, also more tax efficient. And if my explanation didn't make any sense to you, let me just read to you how etfdb.com defines what an active ETF actually is. They write, most ETFs are structured as passively managed funds, which means they are designed to follow an underlying benchmark like the S&P 500 index, for example. Actively managed ETFs take a hands-on approach. For starters, their portfolios are usually more concentrated in securities that management deems to be likely to outperform. All right, this brings me basically to the next chapter of this video. Let's take a look at Cathie Wood, who might be the most prominent active ETF investor, I guess. And the most prominent product of Cathie Wood is the ticker symbol ARKK ETF. It's the Ark Innovation ETF. And I've actually done a couple of videos on this ETF, and I think I mentioned it in a ton of videos as well. And what's worth highlighting is that this fund, as of today, manages around, I think a little less than 6 billion in assets under management. But what's interesting is that back in 2020, this ETF actually doubled in value and at its peak was managing around 30 billion in assets under management. This also means that many investors that invested into this fund during the pandemic years have actually lost a lot of money. I think if you take a look at the performance of this fund since inception, it actually delivered a positive return, but many investors did not get to enjoy these returns. I looked up some data. So according to Morningstar calculations, the average return of investors in the Ark Innovation ETF was actually a negative 17%. Now, a few more things worth highlighting here. The expense ratio of the Ark Innovation ETF is actually 0.75%. Also, many of her bold bets, like for example Tesla, again in the pandemic eras, and Zoom communications, they haven't turned out the way she anticipated to. In fact, I did a video on some of the forecasts that Ark Invest, Cathie Wood, and her team made with regard to the stock of Zoom communications. I highly recommend checking out this video next, and actually agree with the conclusion the authors of a Barron's article on Cathie Wood's ETFs drew. So they wrote that Cathie Wood's ETFs are, quote unquote, one of the largest scale failures we have ever seen in the fund industry. It's a major fail. Now, you may be wondering what kind of fees other active ETFs actually charge. And what I've done is I headed to etfdb.com again. I looked up a list of active ETFs and I just randomly chose a couple of them. So let me just present a few examples here. So for example, we have the iShares Future Financials and Technology ETF with an expense ratio of 0.71%. Then we have the iShares Large Cap Value ETF with an expense ratio of 0.55%. Then we also have the JP Morgan Active Value ETF with an expense ratio of 0.44%. I also came across the T. Rowe Price US Equity Research ETF with an expense ratio of 0.34%. And finally, the JP Morgan Fundamental Data Science Large Core ETF with an expense ratio of 0.3%. And I might display more expense ratios on screen right now just to show you what kind of range the fees usually fall into. And actually Morningstar recently highlighted that the average fee charged by active ETFs has fallen from 41 basis points, so that's a fancy way of saying 0.41% back in 2013 to 0.27% today. However, and I think that's also worth highlighting, is that Morningstar also concluded that the proliferation of active ETFs nowadays has overall lifted the average expense ratio of ETFs. Now, again, to get back to the question of whether active ETFs are a blessing or a curse, I think this is something you would have to assess on an ETF by ETF basis, on individual basis. Just to show you one example here, I think I mentioned the T. Rowe Price US Equity Research ETF. And what I'm going to do now, I'm going to show you on screen the underlying holdings of this ETF. And to be honest, I'm not quite sure how much value these fund managers here are actually adding. They just have exposure to pretty much the largest companies in the world, the big US tech names. We have Microsoft, Apple, Nvidia, Amazon, Meta Platforms, Google, Tesla, Berkshire. Really, those are pretty much the largest companies in the world. And I'm not sure whether you really need exposure to an active ETF, well, to give yourself exposure to these large names. If I were to invest into a fund run by an individual investor, I would seek out an investor that is actually looking for hidden ideas that are not covered in the broad market indices, undervalued opportunities that will actually enable him or her to significantly outperform the market. I think this is one of the biggest edges we have as individual investors. We have no restrictions. We can invest all around the world in companies of all market caps, in companies of all industries, and so on and so forth. Yeah, and this kind of brings me to a problem with regard to the active fund management industry in general. And let me quote someone who I really look up to, Tihur Birkern, who, somewhat frequently posts on Twitter, and he quite recently posted the following. He wrote, "There are two types of investing, and a private investor needs to be able to differentiate between them so as not to fall into a trap. First, the business of investing, gathering assets and charging fees. And secondly, the profession of investing, meaning generating excess returns above the market." And to continue quoting him here, "Unfortunately, most people in our industry fall into the former instead of the latter. The incentives are too powerful in the asset gathering business, so it's rare to see an actual investor busy generating return on investment as opposed to increasing the size of assets under management." Yeah, and Tiho addresses a couple of problems that I have with the active fund management industry as well. I think you just too frequently encounter wrong incentives. Many fund managers, they are incentivized to play the short-term game. And this is partly also caused by the client base, because many investors, well, they are short-term focused, they are impatient, they are unable to withstand volatility. And what do you do as an active fund manager to not see people fleeing your fund when times get a little rough? Well, obviously you diversify, you maybe over-diversify. You, to quote Peter Lynch, you diversify. You pick stocks that are somewhat resembling the index, so you make sure you don't underperform the index significantly at any point in time. And of course, there are also mandates and restrictions associated with many funds. If I go back to the list of ETFs, active ETFs that I was mentioning earlier, for example, one of them was called JP Morgan Fundamental Data Science Large Core ETF. And clearly, this ETF is going to be very focused on one or maybe multiple sectors, but sectors associated with, well, data science, which somewhat artificially limits the universe of stocks that the investor can choose from. Yeah, and as a result of all of these points, the data is pretty clear. I just checked the most recent S&P Global SPIVR 2023 scorecard. And according to this report, over a 10-year period, 91%, a little more than 91% even, of all domestic US funds actually underperformed their benchmark, or the benchmark of the S&P Composite 1500 Index. Again, over a 10-year period. That's of course after fees, but I'm sure many and probably the majority of active fund managers also underperform the market before fees. And ETFs won't change that. Let me say that again. ETFs won't change the underlying flawed incentive structures of the active fund management industry. That would be my biggest concern with active ETFs. I do understand that active ETFs probably provide a couple of advantages over your typical actively managed mutual fund. Primarily, these products are going to be cheaper. And so at some point, I think you have to make a decision. Do you want to invest passively, then just invest into your broad market ETF? An ETF that actually tracks the performance of a broad market index. Or do you want to invest actively and then do it yourself, or try to find, and that's like a really, really hard job, try to find a fund manager that can actually deliver value by beating the market over the long term. And that investor, that fund manager, is likely not investing in just the big tech names. So in conclusion, I want to agree with kind of a German financial influencer. His name is Christian Röhl. I guess that's how you pronounce his name in English. In German, you would say Röhl. And he wrote, to translate him here, the old ETF generation with established indices such as the S&P 500, the Stock 600, the MSCI World, or the FTSE All World is actually sufficient to build up and increase assets over the long term. Simple, transparent, fair. The quote-unquote new generation of active ETFs is more interesting for the financial industry than for us. And I think he's referring to us individual investors. So to wrap it up here, what I would say is, of course, you can mix in some thematic ETFs into your overall portfolio if you really want to get exposure to a specific industry, maybe to a specific country, but you don't feel comfortable picking individual stocks in this country or in this sector, and so on and so forth. But make sure that the weight of these bets remains relatively small relative to the rest of your portfolio. What I should also say is that in one of my recent videos, I actually highlighted that I think we are right now in a stock picker's market. So I truly believe that someone with a long-term mindset who can intelligently pick individual stocks has a great opportunity of outperforming the market in the current opportunity set. But I think your average active fund manager is likely not this intelligent, long-term focused investor. And with that, I'll wrap it up here. See you in one of my next videos. Take care.